The Federal Reserve just did a massive media blitz to try and convince America that quantitative tightening was not coming to an end anytime soon. This was very suspiciously timed, as basically all at once over the course of one day, we got news from everywhere about the Federal Reserve continuing to tighten, will continue to raise rates. There's no slowing down to their fight against inflation. Take a look at this. On November 28th, Bloomberg, Fed officials say more rate hikes coming. Williams flags path to cuts. But what he said about that path to cuts is that probably in 2024 we'll start bringing down rates. From Reuters, Fed has a ways to go on interest rate hikes. Brainerd says string of supply shocks keep inflation risks high, and they have to lean against the risk of inflation expectations. Bullard says that the markets are underestimating the chances of higher rates. Keep in mind, these are all from Monday, November 28th. Again, on Monday, we saw that the Federal Reserve Bank of New York President John Williams said interest rates needed to rise further and stay high through next year. In Yahoo Finance, Fed Williams, still more work to do to bring down inflation. Demand for labor and services still far exceeds available supply. We've got broad-based inflation that'll take longer to bring back down. And I don't pay for Financial Times, but Loretta Mester, the costs of stopping tightening too early are high. So we got this massive media blitz today by former and current members of the Federal Reserve saying to the market, do not expect that we will be slowing down anytime soon on raising rates. There's no pivot coming soon. Real quick, just a short amount of time left on my sale for my portfolio allocation course. If you don't know how to bulletproof your portfolio, you need to know how to invest, how much to have in different categories of assets, and how to hedge your portfolio so that you don't have to be vulnerable to wondering, hey, is there going to be a crash next? We're going to have hyperinflation. You don't want to have to worry about any of that. You want your portfolio to be strong and robust to those things. You need to know how to bulletproof it. For a limited time, 50% off. Get in the description below. So what's going on here is something called jawboning. Basically, the Federal Reserve many times will attempt to enact policy through words alone because they know the market will try and front run what the Federal Reserve actually does. So if the Federal Reserve says, hey, we're probably going to lower rates at some point in the future, then everybody is going to buy debt, which would front run the positive outcome of those rates going down, and they can profit off of it. Similarly, if the Federal Reserve comes out and says, hey, we're going to raise rates, then everybody's going to sell debt, which would cause rates to go up. And so they know the market will try and front run what they do. So many times they'll try and have their effect take place on the market through words alone by having the market do the work for them. And so whenever you see a media blitz like this, where you see multiple people, especially former and current members of the Fed coming out and all saying the exact same thing on every single news outlet, that's what's going on here. It's jawboning. Now, this jawboning is likely in response to last week when the market became overly optimistic that there was going to be some sort of a pivot coming soon, and the market started to rally as a result. And what I mean by that is I think the Federal Reserve will be forced to halt their rate hikes and halt their tightening a little bit sooner than what they're making it sound like right now. Take a look with me at this chart of the money supply. This is something that I talk about fairly frequently, but it bears repeating. The money supply started to increase very rapidly in February and March of 2020. After this huge spike here where the Federal Reserve printed a bunch of money, loaned it to the government started spending it, it then came up with a new trend here where it increased, still at a very steep pace compared to what it was at before, but not as steep of a pace as it was increasing during these few months. And what I'm going to show you here is called the Cantillon effect. What we're seeing here is how fast it takes money to hit different areas of the economy. Newly printed money first hits asset prices, not goods and services. So the money supply started expanding in March of 2020. If we take a look at the stock market, it bottomed at the end of March 2020 and skyrocketed from there. The pace at which asset prices increased slowed down in about September, but continued at an upward trajectory until when? The end of 2021. This is virtually identical to this chart that we see here of the money supply that slowed down its pace of increase, but continued to increase until when? Right here, December of 2021. If we look at the money supply right now, as of October 31st of 2022, it's at $21.3 trillion. We see that it was $21.3 trillion back in November of 2021. So the money supply has moved sideways for just about 1 year now. Coincidentally, asset prices started to fall, and we'll get into why they fell and didn't move sideways in just a moment. So we see the correlation here. Money starts getting printed, it hits asset prices immediately. Money stops being printed, it hits asset prices immediately. What about inflation of goods and services though? This is the official inflation numbers from the Bureau of Labor Statistics, and we can see that when 2020 started, inflation dropped because spending stopped when the pandemic first hit, lockdowns, all the uncertainty, everything like that. But the inflation numbers didn't even get back to the normal baseline from the prior few years until March of when? 2021. It took an entire year for the official inflation numbers to come back up to 2.5%. Trillions of dollars got printed starting March of 2020, and it wasn't a year later till the official inflation numbers came back to what they were before. And obviously from there, the inflation numbers skyrocketed to massive records and have started to flatline a little bit, but still very elevated. And remember, the inflation numbers are year over year, so it shows the change in prices from the year before. So the money started to get printed right here, but didn't show up in goods and services until right here. So while the newly printed money hit asset prices immediately, it had about a 1 year lag until it hit goods and services. So if we have to go to December of 2021 to find when the money supply stopped increasing, when would we expect that the money supply flatlining would hit goods and services? Again, we'd expect about 1 year. There's a delay through which monetary policy hits the real economy. It hits asset prices virtually instantaneously, but it takes a long time for that monetary policy changes to work its way throughout the real economy and get into the pricing of goods and services. This would suggest that sometime around December, January, maybe February of next year, we will start to see the inflation numbers flatline. 4%. 3%, 2%, maybe even 0%. Now, I'm not suggesting that the things that have other issues causing the prices to go up will just magically stop, because monetary policy can't affect things like geopolitical issues and some supply chain issues. However, monetary policy can absolutely destroy demand by bankrupting households and taking people's spending power away. And when that happens, on average, prices will stop going up. You might still see prices in some things continue to go up, but on average, what we're likely to see come soon within the next few months is inflation flatlining. Now you might be thinking, well, asset prices fell when the money supply stopped, so would we expect prices to start to fall or prices to start to flatline? And I would expect prices to flatline here, not to fall like asset prices, and here's why. When you have an economy that is over-financialized like the United States economy, you have people that buy into assets on pure speculation, not on anything fundamental. So during this whole time when asset prices are going up, people buy those assets for one reason only, because they're going up. And if you buy something because the price is going up, what are you going to do when that price stops going up? You're going to sell. And so in December of 2021, when prices stopped going up, people started to sell. And what happens when people start to become sellers? Well, that pushes the price down. And if you were only buying it because the prices were going up, you were thinking about selling it because the price stopped going up, now the price is going down from all the other sellers, you're definitely going to become a seller yourself, and that's going to force the prices down even more. But it's very different with prices of goods and services. People are not buying things just because the prices are going up outside of few little isolated incidences. On average, people are buying things because they want to or they have to keep buying them. They're not buying eggs to flip them for a profit. And so with the money supply flatlining here, I mean, it has drifted down slightly. You can see that this trend has started to angle downwards somewhat. It's still pretty much flatlined here, which would suggest that prices of goods and services will flatline. You're not going to see a sell-off in goods and services just because the money supply stops increasing. You have the money supply enter the economy, bids up prices, and now there's enough money to go around to support things at their current prices, but there's not enough enough money coming in to continue supporting higher and higher prices. If you suck a bunch of the money out of the system and then that money supply starts to drop, then there's not enough money to continue supporting prices at those higher prices. So then prices would have to come back down to compensate for the lower amount of money in the system. Look, this is something that Milton Friedman was absolutely right about. He was wrong about a lot of stuff, but he was absolutely right about this, that inflation is everywhere and always a monetary phenomenon. Has nothing to do with velocity, has nothing to do with supply chains. Those are a symptom, not the root cause. Has nothing to do with anything other than the amount of money that is created or destroyed. And when we live in a fiat Ponzi scheme, it is the central planners, the central bankers who determine the price and the value of everything simply by turning on or turning off the money printer. And so as we look ahead at this media blitz by the Federal Reserve trying to tell the market not to get too antsy, to expect that they're going to be taking their foot off the gas pedal for tightening anytime soon here, I think they're going to be taken by surprise come January or February when the inflation numbers just start crashing and hit those 4.32% numbers, and the market is going to take this with absolute pleasure, start to skyrocket right as people, individuals, are experiencing immense economic pain at home. The asset prices, again, always respond before it hits the real economy. But if anything changes, you'll be the first to know. As always, really appreciate you guys. Thank you so much for watching. Have a great day.